Oh yeah. Let's check that we are live, properly live. Should be all good. We are going to be trading US data, potentially. You're probably not going to hear me much while the data comes out, but I'm going to look at the chart, look at key levels that price could target, and then start plotting some position sizes so I know instantly how to enter a position, what sort of size, because obviously we're not going to have a lot of time. I just want to double check that we're actually running live properly. Let me close this. We're actually running. Hey. Looks good. What inflation looks like going into that meeting, and we get that inflation report. What's fascinating to me is what Alicia Levine pointed out, that actually if you get a downside surprise when it comes to inflation, okay. In equities and in bonds, potentially create a cut in the case of weakness, even in PPI tomorrow, because that's of course the potential inflation we're seeing in these products. Let's bloody go and see what's going on. Consumer immediately. It's super complicated. I think we know that going into it, but seeing how companies and seeing how countries are responding to this in unpredictable ways, I think Walmart's a great example of that. I'm going to keep the sort of volume of Bloomberg up so I can listen, but you'll probably still be able to hear me talking anyway through the mic. Have fun. Call your wife. But that's the environment right now. We'll see. I just want to hear what the... I don't know. What are you doing there? Craig Johnson of Piper Sandler joining us shortly. Flexport CEO Ryan Peterson, Mohammed Al-Aaron of Queen's College, Cambridge, Andrew Holmhorst of Citi, and a whole lot more up next. Yeah, perfect. What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way.
So we're looking at the moment, 32 minutes, we've got 32 minutes. Core inflation previously was 0.4, forecasting 0.3, 10th of percentile down on core inflation year on year. Inflation rate slightly down. Year on year, slightly down. Interest rates could be cut by Bank of Canada. That's separate. Okay. The thing is that I'm hearing is that they're saying, how do I fix that? Can I change this? Settings. No, don't think I can. You know when it's flipped around, isn't it? It's kind of pissing me off, but whatever. Yeah, basically the what I'm hearing from Bloomberg at least, what they're saying is perhaps the effects of Trump and his tariffs are not coming in just yet. So this is going to be the calm before the storm, and we're going to potentially see that in the coming month we'll have the data where we actually see what the effect of Trump's decisions are making. So it's going to be a tricky one to gauge. Who knows? The inflation and could come out pretty different. If it does, then at least we'll have a better idea. If it comes out pretty much how it's forecast at the moment, I don't know how we make the decision. It might be the case that I don't trade at all. But we will see. We will see. Let's just have a look. I like this little setup. It's proper good, actually. Full-on streaming setup. Might move this a little bit over there. Had a really good day yesterday. I think we did around 550 Swiss franc, which was good on a 10k account. Let's just look at some key levels.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
There's obviously a lot of fear out there in the market, and the fear is centered on uncertainty.
So long as we're in this environment where consumers don't know the rules, businesses don't know the rules, you're going to be challenged for a while.
So far, the threat of tariffs has been a blunt instrument.
The size of the tariffs and the speed of them, it really dwarfs anything that we saw last time around. And I think markets are reacting accordingly.
It will take a few months to see how these policies pan out.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Waking up to new tariffs in the United States of America with the promise of more to come. 25% tariffs on steel and aluminum. And according to the White House, we're still waiting for the big one. The big one comes in early April, reciprocal tariffs. This morning, we're focused on the data. 30 minutes away. The data point of the morning, CPI in the United States, a week away from the Federal Reserve.
Which raises the question, how high is the bar for the Fed to signal that they are open to cutting rates in the face of potential weakness that we see bleeding into the soft data, perhaps into the hard data? Alicia Levine of BNY Mellon was on earlier, and she said that if you get the whiff of disinflation that people were talking about earlier, even if it's backward looking, it will unleash a rally in bonds that opens the door to the Fed coming out and being supportive to the idea of a Fed put.
This is what we need. And we'll talk about why. What's worse than an economic slowdown? An economic slowdown the Federal Reserve can't respond to. The Federal Reserve would be in a position, if they needed to, if the data got worse, to respond to cut interest rates. Because at the moment, you're not seeing anything like that from the administration. We came into 2025 talking about the Trump put. At the moment, I think everyone's asking the same question. What Trump put?
Well, according to Donald Trump, he's not really looking at equity markets, and he says they go up, they go down. It's a great buying opportunity for a lot of people. What they're focused on is bringing rates down, energy down, which they have managed to do. Which why I think today is so important, though, is because he ran on inflation, bringing prices down. What did we hear of Bank of America Institute yesterday? Grocery prices are going up. Well, if you have tariffs on some of your main trading partners, grocery prices may go up even more.
What have we heard from the retailers? The retailers have come out with some pretty tepid outlooks for 2025. They've got no clarity, no visibility whatsoever. But they have warned they might have to push up prices. They might have to pass this on.
And if you look at the internals of the NFIB Small Business Survey yesterday, what you found was that the largest share in nearly a year of these businesses said that they plan to raise prices in the upcoming months as a result of some of the policy shifts. Again, it sort of raises the question of what the Fed will be looking at and how high that bar is for them to respond at a time when a lot of people seem to be predicting much slower growth.
Small business confidence at a 4-month low. It's hard enough working out what these tariffs will mean for the economy here in the United States. Working out how other countries will respond isn't straightforward either. And we've seen that from Europe and Canada in the last 24 hours.
Canada this morning, according to Reuters, is saying they're going to respond to the 25% aluminum tariffs and steel tariffs. Europe also suspending some of the tariffs they had on goods like whiskey and bourbon, motorcycles, and then they're going to meet collectively in mid-April. We can get an even another response, although it does seem that they are also offering up a path for negotiation. What I find so striking about what Europe is doing is, Jonathan, you mentioned taking a playbook from China. They're going after red states.
Well, it took 5 weeks, but Wall Street took a look at all of this, and last week started to make their downgrades. And this week it's accelerating, and we got that from Goldman Sachs. And it wasn't just the tariffs. It was the idea that we're talking about which ones, the retaliations, what the goal is. And the fact is that if you have that kind of uncertainty, you need a higher risk premium on your assets.
It's not just the market, it's the economy too. The downgrades on both. HSBC downgrading US stocks, Citi doing the same things. Lisa just mentioned Goldman. Goldman have done it on the economy as well. That call on the S&P is built on the call from the economics team, cutting the growth outlook. Morgan Stanley, Mike Gapen, downgraded growth, upgraded inflation. Deutsche Bank warned about the same thing. Considerable downside risks amounting. We'll get more data through the week.
And Julian Emanuel pointed out that right now he sees the market pricing in more of a stagflation type of environment, which has a downside on stocks of about 10%. They're not taking the recession calls fully seriously yet. Should those come into play, you have a much bigger potential downdraft.
Equities doing better this morning, though up by 0.75% on the S&P 500, snapping back after 2 days of losses on the benchmark in America. Coming up on the program, we'll catch up with Craig Johnson of Piper Sandler as a new round of tariffs takes hold. We'll speak to Ryan Peterson of Flexport on how the levies will impact supply chains, and we'll speak to the brilliant Mohammed Al-Lawan of Queen's College, Cambridge, reacting to the latest read on inflation. We begin this hour with stocks rising as President Trump downplays the risk of recession. Craig Johnson of Piper Sandler writing, another round of distribution pushes the stock market into a deeper short-term oversold condition, from which a meaningful rally of 3 to 5% can occur soon. Investors should be very selective. Craig joins us now for more. Craig, welcome to the program, sir. Thanks for giving us some time. Let's talk about that so-called technical damage. How much damage have we done?
We've done a lot of damage. And again, thanks for having me on the show. But we've done a lot of damage over the last 19 to 20 days. We have seen the S&P pull back over close to 10%. And if you break below the surface of this market, you start to see that you've got a lot of stocks that are off more than 20%. In fact, if you look at a market cap range between 20 and 80 billion, you've got nearly a third of the stocks that are now 20% off of their 2024 highs. So the damage has been swift, it has been pretty broad, and at this point in time, this market is setting itself up, though, for a pretty good relief rally. Could be 3 to 5% back toward the 200-day moving average on the S&P 500, but clearly the conditions are ripe for at least a relief rally. And again, I'll say that at minimum, a relief rally, maybe even a little bit more.
Craig, before we talk about single names and what you're screening for at the moment, can we just say at the index level, we spent a lot of time above the 200-day moving average. Where do you find support now?
Well, support right now could be as low as 5,400 when you're looking at the S&P 500. But again, the relief rally is setting itself up, and there's been a long upward trending price channel that's been intact coming off of those 22 lows. And that price channel was violated just a few days ago. Got to keep in mind, though, from a technical perspective, that sometimes you break that level, as long as we're not going to break it for 3, 4, 5 days, and you see a snapback through that, sometimes the computers kick in and say, hey, now is the time to buy. There's been a lot of investors out there that were waiting for a pullback through much of 2024, never got it. Now you got a 10% pullback. I think they're going to start looking at that as a little bit of a potential buying opportunity for select names. And to that point, when you look at what happened yesterday, we saw our mother's favorite index, the Dow. It was down meaningfully yesterday. But when you started looking at small, mid-cap growth names, things like AppLovin, stocks like that, they were actually up materially yesterday in what looked like a pretty heavy tape. So again, I think there's some select opportunities out there that investors are looking for.
Just to build on what you're talking about in John's question, do you still have that year-end target of 6,600?
I've got a few little setups. I mean, they're not really setups. It's more so I know exactly what position size I'm in, because I don't want to be calculating position sizes while the market's going to be moving quick. Chances are it's going to go one way and then go the complete opposite way. So I'm really going to be doing some kind of gambling, but I'm going to try and keep it to low amounts. You know, if I can just pull in an extra tiny bit, I'd be happy. I don't want to obviously destroy what we pulled in yesterday, as that was quite a large amount. I think we did around. I can check.
Where we are now, it's about 12, 13-ish% from where we are now. But
yesterday we pulled in.
I'm not in the camp right now that we're going to see stagflation or a recession at this point in time. Need to see more evidence of that. And again, I'm not the economist, I'm the chart guy. And as I come back and I look at all the charts, there's a lot of stocks that are pulling back to sort of identifiable support levels that I think investors are going to probably want to step up to.
So let's talk about some of those. I'm looking right now, and you have a range of different sectors represented, whether it's financials, Morgan Stanley, or it's tech and Oracle. What kind of technical levels are you looking for? Or is there something fundamental?
Yesterday we did 646 British pounds, which was good.
Fundamentals are going to get priced in through price itself. And so when we come back and you look at something like a Morgan Stanley,
You might be able to see it. I don't know. Anyway, it was good. So bought myself a little bit of a buffer, but still, it's something, of course, we want to try and keep.
We also think they should be overweight financials, and they should also be overweight some of the services companies. And one of the names that we did call out was Morgan Stanley. And if you step back, not look at a daily chart, but step back and look at a monthly chart, you can see stocks like Morgan
21
Stanley
minutes.
have corrected materially, but you're back to long-term sort of support levels. And that's where these kind of stocks can find their footing, whether it's Oracle on the tech side, whether it's Morgan Stanley, or some of those kind of names. But that's what we're looking for, and that's what a lot of our investors are asking us for. Craig, find me stocks that have pulled back the material support that still look constructive.
Good to catch up, Craig. As always, appreciate your time, sir. Craig Johnson there of Piper Sandler on some of the technical damage we've seen over the past week. Finished on financials there. Banks have had a really tough ride of it through 2025 so far. On a handful of names over the last week or so, we talked about wiping out all of the gains post-election on the KBW Bank Index since early November. A lot of that's come from some big names, Lisa, and it goes beyond the traditional banks. It goes to the Apollos, the asset managers as well.
And you could argue it's the ones that were the highest flying in the wake of the election are getting now the most beaten up. And it goes to this point that we were talking about earlier, how much of what we're seeing is simply a momentum unwind versus some fundamental shift in overall trajectory of the economy. Right now, it seems like people are looking for gains. Let's see how much these dollars can take hold, because we are hearing from a number of retail investors that that is the case this year.
Bank of America so far this year, down about 10%. JP Morgan's down about 4%. Deutsche Bank, up about 25%.
Well, yeah, if you take a look at the European banks, they're
versus the
absolutely
US,
flying.
it's absolutely mental. They're the year-to-date moves at the moment, as you can see. Let's
It's a
give you an
lot
update
of
on
just
stories elsewhere this
consolidation.
morning
I
with
think
your
people are
Bloomberg
really
brief. Here's
waiting.
Danny Berger. Hey, Danny.
Hey, John. The Trump administration
Yeah.
is set to nominate Fed Governor Michelle Bowman as the next vice chair for supervision. A person familiar told Bloomberg that the announcement could come as soon as today. Previous vice chair for supervision, Michael Barr, resigned from the role last month. Elsewhere, Canada is suspending plans to add a 25% surcharge on electricity exported to Minnesota, Michigan, and New York. Following that suspension, President Trump dialed back his threats to double tariffs to 50% on Canadian steel and aluminum. Ontario's Premier Doug Ford and U.S. Commerce Secretary announced a meeting tomorrow. Elon Musk is appealing to have his $56 billion pay package restored. The Tesla CEO is claiming a lower court made multiple legal errors in rescinding his 2018 compensation package. Last year, a judge revoked the pay package, ruling it was unfair because the company's directors were beholden to Musk at the time. And that's your brief. John.
Danny, thank you. Appreciate it. Thank you so much. Up next on the program, the Morning Calls. Plus, we'll speak to Ryan Pedersen of Flexport as shippers brace for tariffs, then more tariffs, then maybe lower tariffs, and then higher tariffs, and then who knows. From New York City this morning, good morning. US CPI, 18 minutes away.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now, weekdays.
It's going to be rising to 2.9 from 3.
From the beating heart
The core
of global
CPI
finance,
was a little bit lower at
economics and
3.2
politics,
last month.
and wherever newsmakers are moving markets.
Yeah.
Bloomberg brings you
What?
conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
"16 minutes from now, inflation data in America, US CPI just around the corner. The scores going into it look like this. We're off the back of 2 days of losses on the S&P, set to snap that if we hold on to these gains, and we'll see. We're up by 0.75% on the S&P, on the Nasdaq 100 up by 0.9%. The scores in the bond market shaping up as follows: 2-year, 10-year, 30-year. Yields higher by 3 basis points. The 2-year pushing 4%, the 10-year up 2 basis points to 4.30. We are in the quiet period for the Federal Reserve, but the chairman had the final word going into the weekend, and he said we're not in a hurry. But would it give them some space if we got a downside surprise on CPI, just to change the tone a little bit at the Federal Reserve meeting a week today?
That seems to be what the market is expecting, that the market will dictate and the data will dictate how quickly and how long the Fed can wait before responding. The difficulty with this is it's backward looking. And not only that, but when we look at some of the surveys that show fast moving trends, it shows that companies are planning to raise prices at a rapid pace. And that is potentially problematic at a time where the Fed has a dual mandate and has inflation that is hotter than that 2% goal.
Christine Lagarde, the ECB president, was speaking earlier on this morning at what they call the ECB Watchers Conference. It's a get-together for all the economists who follow the ECB. There's a lot of them. They do this in Frankfurt every year. I've been. It's very boring, but you do hear from the ECB president, and they talked about the era of shocks, and it is an era of shocks, and she talked about the difficulty of maintaining stability in a moment like this one, and I do have some sympathy for them. They don't know what the policies are going to be. They don't know how they will change from day to day. They don't know how other countries will respond. So you can't offer forward guidance in that environment. It's very difficult to do that.
And it's difficult to act with the word that she used, agility, if what you're trying to move is a massive train. And frankly, each of the calibrations to policy take time to come through. Again, it's a mismatch of time frames. If you can slap tariffs on, take them off, put them back on. How do you respond to a potential growth shock that may or may not come through if you're someone who's working on a 6 to 12 to 2 year time horizon?
The multiple you're willing to offer on stocks obviously shifts, right? Which is kind of the point that Goldman were making earlier on this morning, the point that you were making too.
The idea that if you have higher volatility, that means that the risk reward changes because the risk goes up. So the reward might not be, it has to be even greater for you to get in.
Equities up this morning by 0.8%. The data just moments away. Let's get you some morning calls. First up, Jefferies downgrading PepsiCo to hold, saying the stock's current price offers limited upside. That stock is moving to the downside. We're lower by 1.3%. Your second call from UBS, lowering its price target on Coles to $5. The firm's seeing a challenging consumer environment that's likely to persist. Only just positive there by 0.2. And finally, Morgan Stanley lowering its price target on Apple to $252, expecting a flatter upgrade cycle and bracing for the impact of China tariffs. The stock is just about unchanged. That really is one to watch. Let's stick with tariffs. Global supply chains bracing for the impacts of President Trump's levies. Ryan Pedersen of Flexport writing, if imports become more expensive and unreliable, it could indirectly boost US manufacturing. But if US exports become too costly,
I don't know whether it's a good thing. This, I mean, there's a lot of volatility, of course, and there's huge amounts of price movement. But it's also, as well as that, it's also super difficult to actually predict what's going to happen with price. Yeah, it could go up, down. Trump does talk a lot, so price is always moving. He often says things that he doesn't mean. So what do you take as an actual real piece of information to make a judgment off of? It's pretty hard. Of course, there's economic data, but I'm not sure how good this one's going to be, to be honest. If this is for previous month, February, he's not had long, you know.
We have to sit and wait and see. But if they're putting tariffs on Canada, you can expect there's really no safe haven out there for tariffs other than manufacturing right here in the United States.
Ram, we've seen some evidence, just looking at the trade data, of some front-loading in activity to start 2025. You seen the same thing in your business?
I'll turn my screen so it
We saw a lot of that at the end of last year. Yeah, once we, even under the Biden administration, when they put in higher tariffs on steel and aluminum, there was a big push. If you could move the goods in beforehand, you did. We have seen quite a bit of that. Although at this point, April 1st is the deadline for the Treasury Secretary to present a report to the president on unfair trade practices by China, and that was when we would expect more tariffs to come out. Well, April 1st is around the corner. It's a little too late to get at this point to keep front loading before that happens.
Given what you saw during the pandemic when it comes to supply chain and logistics, do you think companies are more prepared now than they were, say, in Trump 1.0?
Well, on some level, the executive leadership teams of companies has a lot more experience dealing with logistics and tariffs, and they're more in the weeds than they were a few years ago. They sort of just took this for granted, didn't pay a lot of attention to the logistics department.
10 minutes. 10 minutes.
Now those, our customers, which are these transportation departments, logistics departments, as one of the largest freight providers in the world, we work with these people every day. They're under the hot seat. They're talking to their leadership all the time. The CFO's breathing down their neck trying to understand it. So in that sense, yes, but not a lot has changed. The ports they don't have a higher throughput than they did 5 years ago, about the same. There aren't larger safety stocks of inventory for the most part. So I don't think we're a lot more prepared than we were in the past.
The president continues to say, and he said this last night at the Business Roundtable, that you need the tariffs to bring manufacturing home. When it comes to supply chains, do you see any evidence that that's happening right now?
Yes, I mean there's a lot of manufacturing happening in the United States, and it's reindustrializing relatively quickly. It's too fast. It's too soon to say, oh, it's happened, as a result of Trump administration. But there's a lot of tailwinds for manufacturing in the United States. In addition to, you have the carrot and the stick. I mean, the stick is tariffs. It's going to be more expensive to import from other places. The carrot is going to have to be things around deregulation and making it easier to manufacture. And on top of that, I think there's some tailwinds with robotics that may make things, pretty exciting actually, and make it less about cheap labor. But those are going to take many years to play out, so it's a little too early to say.
You made a point, Ryan, in your notes, and this is something that John alluded to, that on one hand, it could increase domestic production, but it could decrease the ability for those manufacturers to export some of those goods if you have a more complicated trade mechanism. How much are you seeing exports from the United States dropping off, if at all?
Well, that's been a long-term secular decline. So if you look at the containers entering, and we're in the container shipping business, so we help companies move goods by ocean freight, by air freight too. But look at the containers. If you went back 20 years, for every 10 containers we imported, it was about 8 of exported goods. We're down to about 2. So most of the containers, you see a container ship leaving the United States, 8 out of 10 of those are empty. So I don't think we have a problem of too much exports. That'll be a long time before that's the case. They are, one of the rules in the U.S. Trade Representative Office has asked for comment. So you have until March 24th if you're an American business to submit your comments on this. But they have a new proposed ruling that would require American exports to travel on American-made ships, that 15% of exports would have to go on a U.S.-made ship within 7 years under this proposed rule. Well, the reality is there's not a lot of American-made ships. We're making about 20 a year total. And that counts oil tankers. That's not just container ships. So you just don't have enough ships that would be kind of a pretty disastrous policy in my view, because we're trying to promote, or the government's trying to promote, American manufacturing. And if you're limiting the exports, as a function of how many and how large are these American-made ships, that's going to really hurt American manufacturers. So hopefully that doesn't pass. Doesn't get put through as an executive order. They're asking for comment right now.
Ryan, one thing that we keep hearing from a lot of analysts, that companies can deal with tariffs. They just need to know what they are, and then they can plan for them. Is that your takeaway too? Is that your comment during the comment period to the administration?
That's one of them. I mean, the reality is no one cares what I think about tariffs. Like I'm very anti-tariff. It hurts our customers. It's not good for business. I think I believe I'm a big believer in free trade and human freedom. Let you trade with whoever you want to trade with around the world. But there's plenty of good arguments for it as well. That's fine. What my point of view is exactly what you say is like, well, just get it done with quickly so we can all get back to planning and set up our supply chains, according to the policies. But when it's changing constantly, it's much harder to figure out what you should be doing.
Ryan, just on that premise, you think you should be able to trade with anyone around the world, even if they're not playing by the same rules?
Well, in a pure, the purest form of it, sure. But obviously, I don't believe that we should trade with America's adversaries in North Korea and other folks who are, committing all kinds of rights abuses or whatever else. So we need some rules. I also think that reciprocal tariffs is relatively reasonable policy, frankly. Like if a country has really high tariffs on American-made stuff, then we have free trade on our side. That's not very good negotiation. So I don't think we live in this black and white world where it's that simple. But at its extreme, yeah, I'm a free trader.
Ryan, appreciate it. Appreciate your stance. Ryan Pedersen there at Flex Sport. You said China without saying China. Right?
I did, yeah.
Because that's the wrinkle in the story, and I'm with you. When we had Trump Volume 1 in the first term, Larry Kudlow, the then NEC director, would come on the program and he'd talk about reciprocity and the lack of reciprocity. And I think the argument resonated with a lot of people. In fact, their push when it came to China basically united Washington, D.C. at a time when Washington was very divided. It was the one issue that most people agreed on. It just feels like the goalposts have shifted in a second term in quite a marked way. We're talking about a whole host of things.
Good.
Right, but when it comes to these tariffs that some have been put on and taken back, the ones that continue to stay, the ones that are steadfast, are China. And this potentially, what I hear, is just the opening salvo when it comes to this 20% on China. And the interesting point is in Washington, D.C. now, following Trump Volume 1, it would be hard-pressed to find anyone who's anti-going after China. Remember, those are the tariffs that Biden kept in place because national security concerns outweighed the economy.
Coming up in just a moment, it's 5 minutes away. US CPI, breaking inflation data in America. Look out for that in just a moment. Breaking things down, fantastic lineup for you. David Kelly of JP Morgan, Mohammed Al-Erin of Queen's College, Cambridge, Andrew Hollenhorst of Citi, all here to react. And later, we'll catch up with David Rubenstein from New York City. The data drops next. Futures near session highs. This is Bloomberg.
Three bloody minutes. We should start to see some movement now. Let's just stay calm. I'll just keep my focus for now on Euro US dollar trading. I'm not going to switch between different ones. I'm just going to stick to that. Although it's just fancy at the point, but probably going to see the most movement here. It sucks. I mean, it doesn't suck. I cut out a little early yesterday on two trades, I think, but I just wanted to call it a day. I mean, I was pretty happy with the trading day anyway. It was £600, so I can't really complain. That's good, but let's see what happens. 1 minute 30 seconds.
Listen carefully. Can you hear the rhythm in the markets? Not not just in the syncopations triggered by inflation, but in the preludes
Woman
leading to
10.
global elections, in the dissonance that moves the Nikkei, and the rising chorus.
Well, I'm going to turn Bloomberg up a bit.
There's music
so I can hear. I don't know if you still be able to hear me, but
to listen for it. We'll show you.
More important
ways on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for are clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
The economic data is 25 seconds away. Going into CPI, your scores look like this on the S&P 500. Equity futures near session highs, up by 0.8% on the S&P, following 2 days of losses. On the Nasdaq 100, up by 1 full percentage point. In the bond market, 2-year, 10-year, 30-year. Your 2-year, 398, yields up 4 basis points. Your 10-year up 3 to 430. With your economic data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, we come in with a little bit better news than everybody was expecting, with CPI on a month-over-month basis just up 0.2%, and the core is up just 0.2%. That pushes the year-over-year CPI down to 2.8%, and the core down to 3.1%, suggesting that the Fed could start making a case for additional rate cuts if they wanted to, and they may have to, given what's going on in Washington. We'll get the breakdown for you later this morning.
Mike McKee, thank you, sir. This is a very important data point for the Federal Reserve going into that meeting a week today. The equity response is obvious, like a rocket. Equity futures up by 1.6% on the S&P 500, higher across the board. Check out the Russell. The small caps up by 2 full percentage points. In the bond market, yields lower. They were higher. We're down 3 basis points at the front end. The 2-year, 391. Push it through the FX market. We unlock 109 on euro dollar very briefly. The euro at the moment erasing losses on the morning so far, 109.16. It's a downside surprise on CPI.
The reaction in stocks is bigger right now than what I'm observing in bonds, which is telling. It's that maybe stocks are looking for where the Fed reaction or where the policy response might be. Right now, the hope is leaning more to the Fed than maybe to Washington, D.C.
Joining us now is David Kelly of JP Morgan Asset Management. David, that's some good news going into next week. How much comfort will this bring the Federal Reserve?
Only a little. I mean, if you look at the numbers today, just scanning them, we saw a 4% decline in airline fares, which is probably, that reflects some of the things that the airlines are saying to us about some weakening in demand. But I really think that the Federal Reserve is in a very difficult position here. Until we have some clarity on tariffs, they don't know how much of an inflation kick we're going to get from tariffs this year. And until we've got some clarity on the budget, they don't know how much fiscal stimulus is going to be kicked in next year.
So I've got €1 US dollar position open for 0.31 lots.
This economy is beginning to look like it needs.
News looks good, but I don't know how much it's going to affect it. As they were just saying on the TV, people are going to be waiting for this Fed decision on whether they're going to cut interest rates. Of course, the data is pretty good. So I'm going to expect that slowly price will rise. I don't think it's going to be anything drastic, but we'll see over the next couple of minutes what happens.
This idea that maybe the Fed could come back into play and support valuations even amid policy uncertainty. Do you buy that? Is that something that you think is a correct thesis?
Well, I think that there's some other things on the bond market's mind here. I mean, one of them is that if you look at the numbers that the CBO put out yesterday on the budget deficit so far this year, it looks like we're going to crack $2 trillion this year. I mean, we've got a massive budget deficit. And the weaker the economy gets, the more likely it is that we're going to see even more fiscal stimulus kick in next year. So we've got a deteriorating fiscal situation here, and slower economic growth and tariffs will only make it worse. So that may be supporting real yields here, even if inflation backs off a bit on weakening economic growth next year. So I think there's more than just inflation and the Fed on the bond market's mind.
Which is also a part of the reason why the Fed might have a hard time just embracing this data and then signaling next week that they plan to cut rates sooner than maybe they expected. David, what do they need to see to have confidence in the forward trajectory, given that this is backward moving and we have policy that is pushing companies to act in real time?
Yeah, I think the most important thing would be a sort of a final story on tariffs for this year and for the next few years. We know, obviously, as an economist, I believe that zero tariffs are the correct policy. I think that's a fairly traditional conservative perspective. But some clarity on that is vital for them to figure out, how's the economy going to evolve? I mean, what the Fed has said very clearly 2 days after the election, Jay Powell said, we're not going to assume, we're not going to guess, and we're not going to speculate. But they'd have to assume, guess, and speculate if they move policy right now. And that's what they're trying to avoid. So that the administration and Congress really need to figure out what the policy playing field is going to be over the next few years. Then the Federal Reserve can try to make some decisions.
David Kelly of JP Morgan Asset Management. David, thank you. The Federal Reserve meeting a week away. David really painted a picture of what a tricky position this Federal Reserve is going to be in a week from today. It could have been trickier without a data point like the one we just got.
At least they don't have runaway inflation, the idea that coming into a potential inflationary shock, albeit a one-time price adjustment, there is some sense
if it doesn't
of
close the way I want, then I think I might shut position. Even though it's only down, so this red, basically top bottom line is going to be negative 100
investors, let alone just the Fed.
If you are just joining us, welcome to the programme. Moments ago, a small downside surprise on CPI. Headline month over month, 0.2%. The estimate 0.3. Stripping out food and energy, 0.2%. The estimate 0.3. To discuss this and a whole lot more, joining us now is Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, welcome back to the programme, sir. Good to catch up with you. Important data point. How does this change things, if at all?
So if you talk to economists, they'll tell you looking back, it's good news. Looking forward, there's very little information content because of what David just said, what we've been discussing all day, is we don't know what the pass-through of expected and actual tariffs will be. So that's where the economists are. For those in the market, having been disappointed on the Trump put, this is better news on the Fed put. And I think that's why you're getting such a strong reaction on the equity side.
There's been so much confusion, Mohammed, about tariffs in the past 24 hours or so. You wear several hats, one of which is you've been a business leader for many, many years. And I think you made the important distinction when we had the boom of inflation. You made the point that this was not going to be transitory because of what you saw at the corporate level, how companies were acting and how they were responding. Given the threat of higher tariffs still to come, what do you see now from companies? And what does it indicate to you about what data might look like in months and quarters to come?
So two things are obvious to me, John. One is that companies have gone into a wait and see attitude, and understandably so, especially if you're multinational. You need clarity. So you're postponing decisions because you don't want to make a decision that ends up being a big mistake because the world has changed on you. So we are seeing business activity slow down. The second thing we're seeing is people are much more ready to pull the trigger on price increases than they were in 2021, 2022. So if these tariffs stick, and if we get more tit-for-tat trade issues and things like that, then the pass-through to prices will be quick. And it will come at a time when demand is softening. So then you bring the third issue, which is the consumer. The consumer is hesitant already. I take seriously what you've been saying, all of you saying about what's happening to airlines, what you're hearing from different retailers. There's been risk aversion, clarity on the sense of the household. So put all that together, John, it is a wait and see economy that cannot absorb much of a price hit.
Is it an economy that could potentially enter a recession this year, Mohammed?
My probability is 25 to 30%. It was 10% at the beginning of the year. So there's been quite a big change. Why isn't it higher? Because there's a lot good happening in the US economy as well. But if we get a prolongation of policy uncertainty, then that probability will go up.
There's a question about the response from central banks globally, Mohammed, if you do have this environment where inflationary pressures are going to be stickier at the same time that you have slowing growth. Christine Lagarde called it an era of shock and saying that maintaining stability in a new era will be a formidable task. If the central banks around the world had to choose, what's worse? Allowing inflation to be a little bit hotter but trying to help growth, or suppressing inflation at the risk of not rescuing growth and allowing it to continue to plummet?
So for both Europe and the US, it is the former. These economies can get to stall speed pretty quickly. We don't want that because the damage that creates is significant. So tolerating slightly higher inflation would be the better choice, the way you framed it. But Lisa, remember, these are central banks that made a huge mistake. And they may be much more sensitive to inflation than we would be, given the mistakes they made.
The idea of transitory and not maybe responding to it in the way that maybe they should have. I'm just wondering if, let's say they did take what you just said seriously, and they did say, look, we're going to have to just tolerate higher inflation for longer, and we really need to address slower growth. How many times would you expect them to have to cut this year in order to offset some of the uncertainty and, frankly, the consumer demand destruction that we're seeing in real time?
Yeah. So to be clear, if 2% was really the operative inflation target, we wouldn't be speculating on how many cuts. We would be speculating on the timing of the hike.
I don't want to speak too soon on it, of course, but we see price shoot up, above this peak. That would have taken out a lot of people's stop losses. Price shoots down. There would have been also people who would have opened positions and had a stop loss below this peak. We can see it's triggered it here, and we see price kind of bounce up again. Where this candle closes is going to be quite telling of now what's going to happen, because price, whatever happens after this candle, is essentially the direction I think it's going to go in. Now that the two sort of stop loss levels have been triggered. So we'll find out what is going to happen. We've got two positions open. We're down -55.
One of your best calls. You are probably one of the best risk managers that I know, that's for sure. I want to talk about February 19th. February 19th, all-time highs. And not the February 19th all-time high of 2025. The February 19th all-time high of 2020. And I remember you came out around that time and you said, don't buy this. Now, the equity market has corrected in 2025 10% from the all-time highs of February 19th. That is quite a parallel to think about those two dates. Mohammed, what would your approach be to markets now and equity specifically?
So I'm asked this all the time, John. I was asked it this morning by someone here.
Wait, why did I buy the euro? How stupid.
It's very tempting to buy because with 10% off on the S&P, with 13 to 14% off on the NASDAQ, I
wanted to sell that. That is really embarrassing.
What mistake can you not afford to make? Most mistakes in the investment world are forgivable over time. And that's the great thing about the investment world. If you bet on something that defaults, that's a different issue. So investors need to understand how much tolerance do they have for short-term mistakes and how much tolerance do they have for volatility, because the probability of both these things has gotten a lot higher than it was at the beginning of the year.
Mohammed, appreciate your time. You're one of the best. Thanks for catching up with us. A good friend of this program, a good friend of ours, Mohammed Al-Erin of Queen's College, Cambridge, on some of the latest market moves and the latest economic data. If you are just joining us 11 minutes ago, CPI just dropped in America. Michael McKee is back with us for more. Mike, second read of things, what jumps out?
Well, obviously, and this was mentioned, airline fares were the biggest drop, over 4%, and at the same time, used rental cars rather fell. So it looks like travel cut back somewhat during the month, and we saw that reflected in the airlines yesterday in what they were saying. Eggs were up 10%, still rising during the month of February. That contributes a lot to a 2% rise in food. Coffee also up. Bacon was down, the one good part there. We were looking through these numbers to see if there was any kind of pull forward on tariffs, and it doesn't look like it at this point. That people were trying to bring in a lot of stuff, and that caused the price to go up. Toy prices actually went down on the month, and that suggests that we got to wait till maybe tomorrow's PPI to see any kind of effects like that.
Mike McKee on the latest economic data. If you are just tuning in, small downside surprise relative to expectations. Equities off like a rocket after that print. As often happens, though, sometimes these moves don't stick. Those moves fade. Still positive and near session highs on the S&P relative to where we were before the print. We're higher by about 1.1% on the S&P 500, up by 1.4 on the Nasdaq. Yields were a little bit lower off the back of this story, now higher by 3 basis points on a 10-year to 431, and at the front end of the curve as well. We're back to about 397. Joining us around a table, I'm pleased to say, Andrew Honhorst at Citi. Andrew, good to see you, sir.
Good to see you.
When you walked into the studio, Lisa asked you a question. It was the title of your recent note. Is the Fed still in a good place? So let's ask you that question. We've got an update, got some data. Is the Fed still in a good place?
I'm not sure that they are, John. I don't know that they're going to recognize that at the upcoming FOMC meeting. It may be more of a wait-and-see meeting. But if you think about where they are, they've had policy at a restrictive setting because they've been trying to wring the last few basis points out of too high inflation. And you can do that as long as growth is resilient. But now we have some questions about whether growth is resilient. So I think they will be reducing policy rates. You would at least want to get back to neutral.
If I was on an investor committee right now, I'd want to be speaking to the economist and then the person who was managing rates, because I want to know why yields are up off the back of a downside surprise on CPI. Can you figure that out for us? How does that make sense? What's the overarching fear here that's dominating things, that's really in the driving seat? Because it doesn't seem to be this data point.
Yeah, I think we really are looking to the growth data. On the inflation side, I think is that weakness that we're seeing in inflation this morning, if it's in airfares, if it's in some of these more transitory, to use a term, if it's in some of these more volatile categories, that's less relevant. What we're really looking through to is what's PPI going to be tomorrow? What's PCE going to be at the end of this month? Where are shelter prices running? Where's that underlying trend in inflation? You really want that under control because we do have these upside risks from tariffs.
You know, Mohamed El-Erian keyed down on a point that I think is really important. He's saying that probably this Federal Reserve and frankly the ECB should prioritize addressing growth concerns, even at the expense of pushing out the timeline for when inflation will get back down to 2%. And it seems like on some level, the Fed had been doing that and then got burned with transitory. So there's this question of, are they going to do something different this time and remain on hold for longer, not addressing growth concerns because inflation is sticky and has been?
So I think they're trying to develop a framework around this, around what would be a so-called one-time price effect that you could look through, a price level movement that you could look through. And if you see underlying inflation in things like shelter and other categories that won't be affected by tariffs, if those are staying cooler and you see inflation expectations that stay anchored, then you can be cutting even if you're technically above target in terms of core because you had this one-time price level effect. And I think that was the mistake that they made in the earlier inflation episode because we actually saw inflation across categories and we were still calling it transitory.
So this is actually really important, and it goes to this idea of, do they adopt a 2-point something kind of framework of inflation that they will accept, and talk about the importance of avoiding a long-term stalling out that could be potentially much more pernicious for the economy. Is that what you think they're going to have to do to explain some of their actions in a non-political way and in a completely politically fraught moment?
Yeah, I don't know if they're formally going to adopt that as a framework, but I think this kind of intellectual development of this idea that, yeah, you can have some months where you're running at 2.5% inflation, slightly above the target if you think it's a one-time movement above the target. That's important.
So you have come out, and you came out last year, and you said the economy is going to weaken a lot more than people expect, and you expected the Fed to be cutting pretty aggressively. Have you seen anything in the data so far that highlights that view, that it has been a very weakening economy going into this period of uncertainty, regardless of the tariffs, kind of Neil Dutta's point?
We saw a lot of resilience over 2024, but we also saw signs that things were maybe not as healthy as they looked. Some of the things in the labor market with a low hiring rate, delinquency rates that were rising for consumers. So we knew that underlying softness was there and might get triggered at some point. And now as we're coming into 2025, remember, this is data that's really before we had a big concern over tariffs, and we're seeing consumers that pulled back in January. We have all the anecdotes from the retailers and the airlines. So it does look like that weakness was catching up with the economy, and that was before we were hit with any kind of new shocks.
So make us a forecast. FOMC's got to put out the SCP next week. How tough is that going to be?
Very difficult. I don't think that they want to surprise the market hawkishly here, and the market's pricing a little more than 3 rate cuts in for this year. So I think that dot for the end of 2025, that median dot, I think will show 3 rate cuts instead of 2.
How do they engineer that? They all get around a table and say, we can't do this? Do they actually independently put through forecasts and then we look at the median, or do they sit together and say, well, you've said this, you've said that, we need to make it this? How do they even do
There
that?
are a lot of bilateral conversations that go on, then they all meet together. Somehow it all works out.
Bilats.
Andrew Honhorst, City. Bilats at the Federal Reserve.
Yeah,
We've seen them in Jackson Hole. They are
It's
real.
true. Yeah, go for
Sideline chats.
It's true, bilat hikes.
Not going to name names, but they are real. Let's get you an update on news elsewhere this morning. Here's your Bloomberg Brief. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John, just to revisit that CPI data coming in softer than expected in February. It rose at the slowest pace in 4 months. Core CPI up 2.2%. That is slightly lower than the estimated 0.3% in our survey. The Bureau of Labor Statistics said nearly half of that advance in the overall measure was due to shelter. Elsewhere, House Republicans passed a bill to keep the government open past a Saturday shutdown deadline. The bill will likely need the support of at least 8 Democrats in the Senate to become law. If it fails in the Senate, Republican leaders could try to pass a shorter-term stopgap later in the week. And in sports, Tiger Woods will likely miss the Masters tournament next month. The 49-year-old posted on social media that he underwent a procedure on a ruptured Achilles tendon. He said the surgery was minimally invasive and went well. Woods set the Masters record last year by making the cut for the 24th time in a row. And that's your brief, John.
Hey, Danny, thank you. Appreciate the update. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. A lot to get through. And looking ahead to next week, a week today, the Federal Reserve has got to get together, put out some forecasts. How do you put out some forecasts when you don't know what policy is going to be and it can change from day to day and within the day 5 times with great difficulty? Equity futures right now in the S&P positive by 1 full percentage point. The opening bell is about 41 minutes away.
Is the Vivian Tom clientele? Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they are important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, they're like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
The opening about 37 minutes away. Equity futures going into it, holding on to gains. Post CPI, equities firmer here by 1.2% on the S&P, up by 1.6% on the Nasdaq. If you are just joining us, just tuning in, CPI came out at 8:30 Eastern, so about 23 minutes ago, and it came in a downside surprise of 0.2%. The estimate was 0.3%. That's on both headline month over month and on core. So equities off the back of that, just a little bit higher. Let's talk about the week ahead, the day ahead. Here's your trading diary. At 10:45 Eastern Time, President Trump meeting with the Prime Minister of Ireland. Thursday, PPI and another round of jobless claims. Friday night, the US government shutdown deadline. Look out for you, Mitch, that day as well, earlier on in the morning. Sneak peek of next week for you. Retail sales on Monday. Another big data point, an important one, going into the Federal Reserve on Wednesday when they deliver their decision. Talked about equities and reaction to CPI. Just want to talk about the bond market briefly. Mentioned this earlier on the program. This is what's so difficult for a lot of investors right now. Bonds are behaving in really unpredictable ways. So if I said to you going into this print, what would yields look like if we got a downside surprise on CPI? You might say, yeah, I want the details. I'm not giving you them. I just want to know, what would it look like post CPI on a downside surprise? And most people would have said lower yields, and that lasted about 10 seconds.
Which is really fascinating to me. The bond market is getting a different message. They're looking ahead. They're seeing less than 3 cuts now being priced into the market from the Federal Reserve. They're seeing the forward look as being potentially more inflationary than the past look, and they're saying the Fed might have a more complicated decision ahead of it than what maybe the stock market is suggesting.
You have to think there was a sigh of relief when you saw the downside surprise on inflation come in, and then all of a sudden, oh no, but we want rates to be lower. So a bit of a whipsaw, I imagine, going on in the minds of Scott Bessent this morning and the president. I take away from all of this after yesterday's 24 hours, the market is desperate for clarity, and they're not going to get it with this president.
It's a policy-driven market, and that policy is being driven out of the White House. We spoke to David Kelly of JP Morgan just moments ago. Asked David whether this would bring the Federal Reserve any comfort going into next week. He said maybe a little bit, not much.
They need to look forward. The problem is, and this goes to Mohamed El-Erian's point, if you get consumers that are already retrenching some of their spending, do they need to come out and say, look, we're not targeting 2% this year. We have a different framework. This is what it is.
If this one stops out, then
coming up tomorrow,
we'll
the
just call it
conversation
a day.
continues. John Stolfus of Oppenheimer, Greg
Try
Dacko
and
of EY, the former
make
trade
something
official,
out of it.
Katie Kalukowicz, and Dirk Willer of Citi. Look out for that one. Citi downgrading US equities in the last couple of days. From New York City.
It's a good looking
thanks for
trade
choosing
to
Bloomberg
me
TV.
because
This was
perhaps the
Bloomberg
entry
Surveillance.
here would have been better. But, you know, you've got 200 EMA, we're undersold, news is pretty bad for inflation.
Another special BNP Paribas
We've got a
Open
previous
update
high of the, where we've got
from
the sort of
Tennis Channel.
0.95 level that I feel like it would target again.
Match against Carolina.
So I don't know,
The Polish star
we'll
took
see
under an hour to put the win in the books, dropping just 2 games on her way to the
what happens,
quarterfinals.
happens. Probably going to get stopped out. But it's okay. It's 1.4% down.
Which have hosted the Olympics have always companies grapple with the issue of infrastructure, for instance? Building it is one thing, maintaining it is another. How can India do it differently if it were to host Olympics?
You're talking about innovation and sustainability, and I think the same goes for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Oh dear. Yeah, that's a stop out for sure. Any second now. Go on. Hit it. Oh, hit it. Done. No? How's that still in? Out. I don't know why it's not closed on here. Worrying.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Futures flying high.
My stop is definitely set for that level, but it's still open, so I don't really get that. I don't really get that at all.
Coming up, bonds drop, stocks rally. U.S. inflation comes in lower than forecast, and it's offering some relief after months of stalling progress.
The global trade war enters a new and perhaps risky phase. The EU fights back as President Trump's steel and aluminum tariffs officially kick in.
Just gonna go to the toilet. Back in a minute.
Then you take a look at the bond market. You actually have yields rising across the curve right
assumed tariff rate and a higher level of uncertainty. And that has really been what we've been hearing from the sell side all week.
What's the saying? The shoes are
I have
falling.
no
the
idea
shoes
how
are
that's still
dropping.
in.
The next shoe to drop.
Yeah, they're the next shoe to drop. Anyways, the other part about this, too, the inflation data, you see that stagflation worry, to your point that you were making a little earlier today, starting to be a little bit eased. And that is kind of one of the worst case scenarios you could have for the Federal Reserve. Speaking of the Federal Reserve, we're going to break down the inflation data with Bloomberg's Michael McKee, our top Fed watcher here at Bloomberg Television. Mike, when you looked at the data, bring us the good, the bad, and the ugly.
Well, the good was the decline in both the headline and the core. Significant decline in headline, especially because gasoline prices and airline fares went down, but 0.2 compared to 0.5 the prior month. And that gave us a 2.8% annual rate. That's the lowest in some time for CPI, 3.1% on the core year-over-year basis. As prices continue to decline. No change in housing. That was maybe a little bit of disappointment. There's hope that it continues to go down. But what moved, we have a sort of truce in the war on breakfast. Eggs and coffee up a lot during the month, and natural gas because it was cold. Rental cars, along with airfares,
and when the stock goes down
Sure he does.
50%, right?
Donald
that's-
Trump is his following now, right?
But I think there are places to buy. Like, I'm looking for turnaround stories. So, like, I still like Gap, right? They had good earnings last week. They had a bump from it. You know, I think, you know, if there are some more tariffs that are coming with China, you can see them taking market share from Shein and Temu, perhaps. And they also have just working on their own business. I think there's value in European large caps. I think there's value in Chinese tech names. Like, I think diversifying outside of the U.S., because U.S. exceptionalism is now being questioned, is the right thing to do as well.
Yeah, Citi would definitely agree with you there, especially when you bring up China. But I want to talk about other turnaround stories that just can't seem to blossom. I'm going to the small caps and the mid caps too. I mean, people have been waiting and waiting for that trade. Maybe I've been waiting for that trade. What's the outlook there?
I was also in that bandwagon. I actually favored mid caps over small caps because I felt like small caps, you know, interest rates are going to be hard. Longer term interest rates are going to be hard to get down because we also have a decent deficit. And if we do have a slowing economy, tax revenues are going to come down. So we just have to watch that.
Dude, and it's bleak. I mean, come on. If you need to reshore production, we had a great story on the guy who made the pedals for Nirvana and Jimi Hendrix today. It's easy to do it's easier to do if you're a multi-billion-dollar company. If you're a little guy, tough.
But one of the narratives, one of the bullish cases for small caps is that a lot of these companies are very domestically focused.
Yes.
So maybe they would be insulated from some of these
And
things.
deregulation and possible M&A, it just doesn't, it hasn't come. It has not been the focus of the presidency. And there is a question about M&A, like, you know, being easier. So I think that's what's been hurting it. I still think there's opportunity in the mid cap space, and it hasn't been down as much as small cap, but you know, this has taken everything down.
We have no verdict on M&A yet, right?
Jury's out. I mean, one banker.
Chris Hughes may have been right.
I gotta bring him on.
For the wrong reasons, though. I mean, what's interesting is with rates still high and with valuations all over the place, there's a lot of pain under the surface, guys. So you have to come to market. It just might not be at the prices you like. Stephanie, thank you so very much. Whole market just waiting for Godot. Stephanie Guild of Robinhood Financial. And coming up, we're going to get more details on the latest tariff on metals and the first signs of retaliation next. This is Bloomberg.
So I've just opened a GBP JPY. Doesn't seem too affected by the news. It seems to me that we've got quite strong levels.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all
Perhaps we
things
see
crypto.
a-
The people.
The tectonic shift emanating from
orbit
Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a
important that
global
this
on-chain
candle
economy.
closes
And if
above
America
this
doesn't
bottom
embrace
there,
it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
kind of want to closure above.
You've released
As confirmation. If it doesn't, I'll close
a reggae
the
album,
position,
a
I
gospel
think.
album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your
I will do these streams more, but the thing is I don't really do any work in the evenings anymore, so it will only be on Wednesdays and Fridays, but maybe that's a good thing. But it won't be too much. Oh, what's going on in, with
Mark Terry, which was his.
Yes. Is it ABC?
In the south of Russia, an area of Russia which the Ukrainians had occupied, hoping to use it as leverage in negotiations. Well, things are not going well for the Ukrainians there, but he's made a point today of saying Ukrainians are still fighting, they're still in Russia, still battling away. And that combined with that drone attack, this is trying to give the world a sense that Ukraine is still in this fight. But we might be on the edge of something much bigger.
Good
that
to
is
see
peace,
good to see an increase
if
here.
Russia agrees. And that's
Turn that down a little bit. good.
James, Russia
Obviously, there's
says
a
it still
ceasefire, I
needs
believe, in
more
Russia.
information about the ceasefire proposal. So how significant is it
Yeah.
simply to be at this
I'm glad we
point
saw
where
that green
Ukraine has
candle.
agreed to
How
the deal,
our
and
stop
Russia
didn't get
says it's
triggered,
open to
that
discussing
is a stroke of, I don't know what you can call that.
Hugely significant, I think, Diane. I think it's we
Let's
should
check on the
underplay
30
where
minute.
we are now
We've still got 15
with
minutes on that
these
candle. It's also
negotiations.
an
the beginning
important one
of
that we have to
negotiations.
close
I'd
about.
ask you to think. Imagine this hypothetical, that President Biden had done this, that then Secretary Blinken had come out on the world stage to say, look, we've brokered a peace deal with the Ukrainians. I think almost immediately you would have heard from Moscow, you would have heard from the Kremlin immediately shooting it down, immediately saying it's laughable. That
Intelligence
isn't
sharing
what is
with his country. Negotiators from the two nations reached an accord in Saudi Arabia for a peace deal with Russia. Trump now has to put the pressure on Moscow to agree to the deal and accept
Moscow.
a ceasefire, beginning
Why
with
do
a
they say it like
30-day halt to the 3-year-old conflict. Russia's foreign minister said this morning that the nation would not accept the presence of NATO troops on Ukrainian soil under any flag or in any capacity. House Republicans passed a bill to keep the government open past a Saturday shutdown deadline. The bill will likely, though, need the support of at least 8 Democrats in the Senate to become law. If
It's not
it
that
fails
bad.
in the
65
Senate, Republican
is-
leaders could try
it's
to
not really
pass a
a crime,
shorter-term
is it?
stopgap later on in the week. And the Trump administration will nominate Fed Governor Michelle Bowman as the next vice chair for supervision. This, according to Bloomberg sources. The announcement could come as soon as today. Shanali has been excited about it for like a year. The post was vacated by Michael Barr, who resigned earlier this year. Bowman's nomination would have to be confirmed as well by the Senate. President Trump's metals tariffs kicked in at midnight. The U.S. administration has imposed 25% tariffs on steel and aluminum imports, with no exceptions or exemptions for Canada or any of America's trading partners. The European Union is launching retaliatory countermeasures. The bloc plans to impose its own levies on around $28 billion worth of American goods. European Commission President Ursula von der Leyen laid out the bloc's plans earlier.
Our countermeasures will be introduced in 2 steps, starting with April 1st and fully in place as of April 13th. In the meantime, we will always remain open to negotiations. We firmly believe that in a world fraught with geo-economic and political uncertainties, it is not in our common interest to burden our economies with such tariffs.
Let's say with those tariffs, because joining us now, we have Bloomberg metals and mining reporter Joe Doe. Joe, it was great to have you with us when the news broke about potential 50% tariffs yesterday. Now that we finally have some clarity, take us into your reporting. When you called up executives yesterday, what did those conversations sound like?
So initially, when the president announced he was going to double the tariffs on Canada, I spoke to multiple people in the market who are actually supportive of tariffs, basically shrugging, saying, I don't know where this came from. I don't know how we got here. This is a bit confusing. Because remember, these are still businesses. They still like to have certainty to plan for. I do want to throw out one thing I remember from 2018. By the end of 2018, I was going to steel conferences and talking to executives of big steel companies, of re-rollers, everybody in the market. And they said, you know what we need from the president is for him to just make a darn decision. Because you might remember back then he was talking about exemptions, no exemptions, who he liked, who he didn't like. And they said, just make a call. If it's no tariffs, that's fine. If it's tariffs, that's good too. But our customers need certainty. And I think that's what we're going to start seeing here, right now.
I totally hear you, and it's interesting. We have Howard Lutnick, the Commerce Secretary, speaking on Fox right now, and he says they will lower the temperature with Canada. And the world is watching, right? The way that the U.S. negotiates with Canada. 50% to 25%. While I hear you on the certainty, that's gotta be some relief. You almost wonder whether he said the 50s so that everyone would get comfortable with the 25.
Well, by the way, I mean, how does nobody give, you got to give credit to him for that win, right? Everybody's like, Trump backtracked, Trump retreated. He got Ontario to take off a 25% tax on energy exports. Someone's got to give him a little credit for that, right?
I don't know if anyone has to give him credit or if they have to give him full credit, but I do know that talking to service centers in the space yesterday, they said, listen, whatever happens, the ultimate person who's going to pay for these tariffs are consumers. And they're going to pay for it at a time when demand is weak, inflation is high, and borrowing rates remain high. As I mentioned yesterday, steel inventories across this country are at the highest in years. And now you're adding 25% more price on top of what they're already not paying. And this was one other thing that a service center person told me yesterday was, you're asking the consumers to pay more, and yet they're not buying.
It is interesting about the payee, right? Because Warren Buffett said on CBS last week, it's not the tooth fairy that's going to pay these, right? He also said tariffs are an act of war, which I think was fascinating, especially if you put that together with Ray Dalio's comments.
Well, you've heard the phrasing from the Trump administration that this isn't a trade war, it's a drug war. But to your point that there's been this narrative that these tariffs are being used as negotiating tactics. So spin this forward for us, because you write in Bloomberg News today about, there's calls now for more talks. What does that look like?
I think I go back to what was initially discussed across Washington, D.C. from major sources within the steel industry going back to November 7th, right, the day after the election. And what had become apparent to me, talking to different folks across this, they said what's going to happen is he's going to go all in on the tariffs, specifically aluminum and steel. It's going to happen. And once they go into effect, he'll negotiate backwards. Now, listen. I don't think any of them expected the kind of back and forth that we have seen for the past 2 months, right? On a Friday, we're going to do this, but on a Monday, no, we're not going to actually do it. But I do think we have gotten to the point where these tariffs have come in place for steel and aluminum, 25% steel, which we had before, 25% aluminum, that's much higher. But there is obviously still room for discussions. We do know, we have reported that there was a lot of lobbying efforts.
Oh, what's happening?
The airport is fully back open now. Diane?
Alex Perez, thank you. And 3 people are facing charges in connection with an alleged campus hazing death in Louisiana.
No, it's obviously we lost. We had 3 positions open. It was quite quick trading. It's pretty poor trading as well. It's not something that's a huge amount of technical analysis behind it. It was fundamental. I looked at the data. I actually made a massive mistake because actually the data wasn't so in favor of the US economy. It was more in favor of showing a weakening economy. Sorry. Yeah, it showed a bit of a weakening economy. A lot of the decision on what's going to actually happen with price, I think, is more going to be on how the Fed and what they do with their interest rates, if they're going to cut them. We'll see. So this data wasn't so, strong. But we had a buy open initially. It was a bit high. It had to be closed anyway, because for it to have fallen down where we saw, you saw I probably bought in around here pretty bad. That would have been a big loss. I shut it quite early. We lost a net of £65. I then had a buy-in very quick, but I thought it was a good idea to close that because we were just doubling down. So I shut that at a profit of £5. Okay, it's not even worth thinking about. We then had a Euro-US dollar sell. That was a loss of 10. That wasn't... When I'm doing it, I'm sometimes also looking at the momentum behind the candle. If the candle's on a smaller time frame as well, don't go the way I'm expecting the pattern to go, I'll just close it. There's no point wasting time and wasting money on something that's not going to go your way. It's going to go that way inevitably anyway, so you might as well just cut it out early if you're sure about it. Now we're sitting at the point where we have 2 trades open. In terms of ones regarding the US dollar, we've got 1 position open for Euro-US dollar as a sell, 0.7 lots. You can see it here. Sorry, as a buy, 0.7 lots. It's about to break even on this chart at the moment. It's important for me that this yellow box has the 30-minute candle closed above, which in 5 minutes we'll find out. That's important for me. We've had a clear 15-minute closure above. We can see a lot of demand below the bottom of that candle. Okay, it could be a good sign, but we'll see. And perhaps it could be something I may... Well, no, I won't layer. I won't layer this at all. We've also got a Japanese yen, British pound trade open. My reasoning behind that is if we have a look at previous highs, we got highs, highs, highs. Okay, we broke through here. Again, highs, highs. It's quite a key level to me. So that's my reason for selling. 4 hours overbought, 1 hour overbought, 30-minute overbought, 15-minute starting to fall a bit. Of course. And we've got no news coming for this for until the 14th in 2 days, and that's GDP, which would be funny. Rachel Reeves, total idiot. Total idiot. What's CNBC saying?
Players. Only 15% of domestic capital has flown into the
And bond yields. And if you're surprised to see such a big reaction to CPI, maybe you shouldn't be. We've had such a big sell-off over the past few days, but also if you take a look at the options market, really interesting data out from Piper Sandler before this print that we got at 8:30 that options markets were priced to swing 1.5% in either direction in the aftermath of this report. Of course, inflation has taken on such importance as we watch these tariffs, as we take the temperature of global trade. And Matt, we were talking about a little bit earlier that we haven't seen the full
Thing is,
force
looking
of
at
tariffs
NASDAQ,
yet
etc.,
in
it's not
February,
really
but
worth.
that is definitely
Yeah,
where
okay,
the
they're
market
going on the upside, but as she just said, there was a huge sell-off. I mean, it lost like 4%. I think it was one of the worst days in the past.
The auto tariffs will go into
I
effect
know.
April 2nd. To me, it's
I can't remember
interesting
what I was
that
going to say,
Europe
but it was a pretty bad
goes
few
back
days
on
for
the
NASDAQ
retaliatory
and US
instead of cutting
indexes
their
and
tariffs on
indices.
US auto imports.
Things are escalating, but this is a market
So
half
that
an
going
hour
up, it's
before.
just could be a correction, to be honest, before it continues in the way its momentum is behind, wants it to go. So I'm just going to hold these two trades. I might even leave them on multi-screen. I'm going to eat in a minute, and I'll leave this running. What is that? Several charts. Not going to fit. Perfect. Stupid thing I used to always do is I was always trading. I was always trading, like, sometimes I'd trade opposing pairs. Like, I'd be buying Euro US dollar, and then I'd be buying US dollar Swiss franc. Proper stupid. Proper stupid. We've got 1 minute to see if this candle closes above.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty. Coming up, an ABC News exclusive with Jay-Z's attorney, what he says they uncovered in their investigation into the woman who accused Jay-Z of sexual assault. Also ahead, the urgent search for a missing college student. See the new surveillance video showing where she was.
Basin mentioned that
California, where the outbreak is spreading, and the new warning from doctors.
Don't want to hear that shit.
इन सबको मैनेज करने का Technology is driving business across Europe.
Companies in Asia are betting on tech.
10, 9, 8, 7, 6, 4, 3, 2, 1. See?
open interest. I'm Matt Miller. You can see gains of more than 1% on S&P futures, 1.5% on NASDAQ futures, but this after huge drops that have pushed us more than 500 points off of the highs. I think about 600 points off of the highs from last month. Take a look at the New York Stock Exchange. You see the opening bell being run there, and no Formula One drivers. But if you look down at the NASDAQ marketplace, look at that. You've got Formula One or Formula Academy driver down there ringing the bell for Red Bull Racing. Really exciting, and I think Formula One actually kicks off this.
Who rang the bell?
MotoGP is far more interesting if you're interested in motor racing sport. In terms of the markets, though, very fascinating stuff going on today. Maybe
Right, just gonna check on my pizza.
out of the CPI. Katie Greifeld, what do you see in the live trade?
Yeah, cooler than expected CPI, but of course we're all focused on the trade picture right now after those import tariffs went into effect last night. We saw retaliation from the EU. Now, perhaps we might see it from Canada. This crossing the Bloomberg terminal right now, that Canada said to prepare retaliatory tariffs on 30 billion Canadian dollars worth of U.S. goods. Of course, this was a bit expected, but you can see that the market really shaking it off to that point. The S&P 500 still higher by about 1%, 1.1% right now. We got a big wipeout over the past few days. We're still lower on the week. So to Matt's point, perhaps a dead cat bounce, though. I don't really like that phrasing. Moving on, the NASDAQ 100 is rallying a bit more. Big tech has been the biggest loser, and as such is the biggest winner on this day, up about 1.7%. The small caps, this index actually ended positively yesterday when you had both of your big guys down on the day, and it's up 1.2% today. We know it's been a year-to-date lemon, so it's still hard to get too excited about the little guys. But back to the trade picture, we're taking a look at shares of metal companies such as Alcoa, such as Century Aluminum, higher this morning. And that's as President Trump's tariffs on steel and aluminum imports go into effect. They're still higher right now as we see the EU and potentially Canada prepare their retaliations. Schneider.
Katie, I agree with you. We will keep on the show all the cats alive. We over here are keeping an eye on Tesla here. It is up almost 7% at the market open. It's higher for the second day. It continues to recover from Monday's 15% sell-off. You have seen some brutal selling in this stock, but you have some key analysts keeping sky-high price targets back.
Yeah, Tesla is a fascinating story, especially after the President of the United States came out and did an endorsement for that company yesterday. Intel, also fascinating. We have a report that TSMC is pitching NVIDIA, Advanced Micro Devices, and Broadcom about taking stakes in a joint venture that would operate the chip makers' factories here in these United States of America. You can see the shares rallying more than 5% this morning. Goldman Sachs, though, has lowered its target for the S&P 500 down to 6,200 from 6,500. Strategists writing our revised estimates reflect the recently reduced GDP growth forecast of our U.S. economics team, a higher assumed tariff rate, and higher level of uncertainty. Let's take a closer look at just one more in a pile of reduced forecasts with Bloomberg's Alex Semenova. Alex, what do you see?
Hey guys, so of course at the start of this week we spoke about how Wall Street was starting to feel increasingly uncomfortable with the ultra bullish targets that they went into 2025 with. At that point, strategists were just talking about how their targets have an increased risk of the bear case materializing, but we're actually having Goldman Sachs this time come out and officially change their year-end forecast to 6,200 from 6,500. I do want to be clear though, they still see an 11% gain from yesterday's close, so they're not actually changing their view that we are going to see upside. They're just marking their target to market. And it's important to note that last year they did mark their target to market 4 times when the market was going up. So I would take this with a grain of salt. They're really just reflecting that 10% correction that we've gotten in the S&P 500 this year.
You know, it's taken a while to get back down here. And Katie made this great point earlier that even if you're at 6,200, you're well over 10% above where we are right now. How much more downside risk is there? Who's talking about the next low?
So I do want to point out, we did an interview with Marko Kolanovic, who obviously left JP Morgan last summer. He was one of the few contrarians still calling for losses at a time that everyone else upwardly revised their S&P 500 forecast. And he said that it really depends on whether or not we get a recession. At this point, what we're seeing is just a growth scare from tariffs, a lot of uncertainty in company guidance about what the outlook is, but we don't have any clear deterioration yet in the fundamentals. So it depends. We could take another leg lower, see some stabilization around 5,500 is what he said. But if things get worse from here, we could go down to the low 5,000s, or if we do get a recession, he sees the index dropping to the 4,000s.
Have to imagine he's feeling a little bit vindicated, and it's been fun reading his tweets or his posts on X. Alex, great interview with Kolanovic. I encourage everyone to go read it, and of course, thank you for your reporting now. That is Bloomberg's Alex Semenova.
4,000.
Yeah, brutal.
That would be certainly something.
The Bears
You're
are
never
about
going to
to
retire.
I know. It's my 401k is just getting hit.
Jeez, yeah, don't even look at it. Let's move swiftly along to that point and broaden out this conversation with Chris Barone joining us at the desk. He is partner and head of technical and macro strategy at Strategas. Great to see you.
Great to be here.
I want to start with the technical part of your title because we were talking a little bit about technicals last week. The S&P 500's 200 daily moving average has been squarely in focus. You take a look at things such as the RSI, briefly getting to oversold territory. When you take out your funky technicals, what do you see in terms of where we're going?
Well, I think this discussion that we're having here reinforces the undefeated rule of Wall Street. It's that attitudes are shaped by price action, not the other way around. And you see these big changes in sentiment over the last couple of days. We've seen big swelling in inverse ETF volume. We've seen some action finally in the put-call data. We've seen the survey work get a lot more bearish. So I think the frenetic pace of the market these last several weeks is really starting to take a toll on psychology. That's generally pretty bullish.
Yeah.
And I think we're probably in the ballpark.
I'll probably stay on for another 4 minutes, then I might call it a day. I might jump on again later, but I do need a break. Not that I've done a lot, but it's been almost 2 hours and I need to eat. And it's nearly 3 o'clock.
More difficult to read in this kind of volatility.
So yeah, no stream tomorrow. Fridays I don't really trade, to be honest, so it might just be a once a week job.
Matt, I think it's where you have to rely on what has really served you well over the years. And one thing we spend a lot of time on is credit, right? What turns a 10% correction into something much more sinister? Typically when credit conditions are really deteriorating or credit is disproportionately worse than what equities suggest. And that's just not the case here. We did some work this morning. Over the last 20 days, S&P is down about 10%. Double B spreads are only about 30 basis points wider. That is not disproportionately weaker to what equities have done. So I still feel okay here. Financials went into this as leaders. I know they got flushed with everything, but they're still generally in pretty good long-term standing. So I don't think this is sort of some major change.
I think that's such an important point.
I just hope that
this BlackRock
Euro US dollar goes up a
you have
little
seen
bit.
this real containment in the credit market, even as you get
It's
scary
lingering.
headlines that issuers are standing down.
Yeah,
It's
those
lingering.
are scary headlines, and it's interesting because not only do you have BlackRock saying, okay, maybe wait for spreads to widen a little more, you have Goldman this morning saying it as well. So
Too
clearly, too tight. Did I do that?
Yeah, that's pretty good.
So, I want to actually switch gears just a little bit to have you weigh in on this tariff rhetoric. We were kind of talking on the sidelines here about what you're seeing in retaliation.
Put my stop losses
EU,
in.
26 billion euro. Canada, another $30 billion. So that's $56 billion on what is a giant in the room of an economy, 27 trillion, right? Just feels like a drop in the bucket here, doesn't it?
Well, so let's think about it in terms of not my opinion, but what's the market's opinion of all of this? And what I have found particularly remarkable over the last number of weeks is while cyclicality has suffered domestically, cyclicality is alive and well in Europe, it's alive and well in Asia. The cyclicals in Europe continue to outperform, the cyclicals in Asia continue to outperform. So, kind of our big call this year was cyclicality isn't extinguished domestically, it's just migrating globally. And I think you're beginning to see that, or certainly have seen that. And I take some comfort in the idea that you haven't seen the cyclicals take the same hit throughout Europe and throughout Asia. I mean, Chinese markets act great here against very low expectations.
By the way, I think almost everything is a drop in the bucket compared to the entire U.S. economy,
But
right?
it will hurt specific companies, that's for sure.
Yeah, I mean, there aren't many bigger numbers than the U.S. economy.
Well, that's what I'm saying. When you're seeing the retaliation so far, it doesn't seem to be that big.
Yeah, and it'll hurt specific companies. It'll also help
I'll
specific
keep it
companies.
on.
I mean,
I'll
we're
keep
talking
the
about
stream on,
Alcoa
but
and
I
US
will
Steel, at least
turn the
from
camera
the
off
share
for me.
prices. They've been acting very
You're not watching
positively.
that.
In the short term.
In the
If you-
short term,
yeah.
yes, you have to zoom out the chart. curious about how you approach this as an investor. So there's so much short-term noise here. Are you
Actually, it's a good conversation. You have to be sitting right here. Lorenzo Gonzalez. Cleveland Cliffs.
You want to bring him in now?
You bet I do. Nice to see you. Good to see you, my friend. Good to see you, my friend. Okay.
Nice to see you as well.
All right, we've got a treat here. It's a man who understands great.
Second half 2021 into 2022, when we were kind of in the throes of that beginning first stage of inflation, your leadership was very pro-inflationary. It was energy stocks outperforming, it was material stocks outperforming. That is not the market's messaging here. Aside from a bounce in materials today, they have not been your leadership.
because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon model.